Dear investors, we welcome you to the a monthly initiative to connect the investors with the markets. Till October 2021, we were seeing an insane amount of liquidity flow into the Indian markets as we touched the level of 62,245. And as of yesterday's close, Sensex saw a level of 55,000. What happened to the great Indian equity run? Today, we discuss global economy, global and Indian markets, and strategies that we as investors can adopt to capitalize these market opportunities in this calendar year. Let me introduce the keynote speaker, Mr. Abhishek Kumar, Managing Partner at Ingenetus. The framework of the session will be we will be discussing in a question and answer session format various topics that we just talked about. The last 10 minutes will be reserved for questions and answers from the participants. I'll request all of the participants to keep themselves on mute as well as keep their cameras switched off to maintain the integrity of the session. And I'll request all of the participants to key in their questions in the chat box. We'll be taking them in the last 10 minutes. So let me begin with the first and most basic questions. Abhishek, what factors hit the Indian market so badly that markets corrected by 16%, Sensex I'm talking about, and then recovered to an extent in the last 1 week?
Hi, Shalini. So Shalini, in the last, many months, the markets were hit by many factors. We'll talk about them in detail in a bit. Uh, but if I have to name these factors, primarily the crude oil, due to the Russia-Ukraine, conflict which happened. So crude oil, I think, moved from about $90 to about 130, 135, which was the highest per barrel, and that's a steep increase in crude oil. The problem was also the speed at which it increased. I think so increased in a span of, I think, if I'm not wrong, between 20 to 25 days. So the increase was very steep. So crude oil, because of the Ukraine-Russia crisis, was the reason. Second was the Fed rate hikes. So Fed decided to increase the rates in US. That was another factor, and due to which some outflows happened in the Indian markets. Um, I'll say UP elections or local elections were not much of a factor. Probably, the markets were looking at it keenly, but the results turned out to be just fine. Uh, and also, I think in March, generally, what happens is March is a year-end closing for a lot of corporates. So there is generally a pull out from the markets in March, let's say till the 2025th, because corporates have to file taxes. So I think these are the three, four factors which hit the markets, which hit the sentiments of the markets, and not just in India, globally.
Right. So you talked about UP elections, Fed rate hikes, FII outflows, and crude oil hike to a large extent. So let's tackle these individual factors now. Crude oil is at $106 per barrel last closing. And in the wake of the energy crisis, to what extent is crude oil going to go, and how does it impact our Indian economy and ultimately the Indian markets?
So yeah, it reached 107, 108. It's gone up to 112 again. Um, so see, what happens is crude for any economy, not just India, is very important commodity, right? So a lot of the entire economy is dependent on it. Your transport is dependent on it. Uh, your for a country, especially for a oil importing country, crude becomes a very important factor, and it's a double whammy. Crude hits you on inflation also because things become expensive. So for basic necessities like your groceries and everything, the transportation becomes expensive, and so does the cost. And also on the other side, it impacts the growth of a country, right? On the GDP side, on a corporate side, corporates profitability reduce because their crude expense increases because of the increase in price. So it's a double whammy on GDP as well, on the growth of the country as well, and on inflation as well. And for a country like India, which is an oil importing country, what happens is that for an oil importing country we have to shell out more dollars, right? So if crude is expensive, the we have to pay the bill in dollars, so the INR to conversion will happen, and ultimately a currency of a country will also depreciate against a dollar, right? uh, Depreciating currency has its own worries. So, if your currency is also depreciating, that's a negative for the foreign investors because their portfolios are hit with a negative returns, right? So, for example, if I am a foreign investor, I'm getting a 20% return on my portfolio. If the local currency depreciates by, let's say, 5%, my net return is 20 minus 5, which is 15. So in that kind of a scenario, I'll probably move out of that particular country. So crude for any country is very important, uh, and that's what happened, and that's what happened in the Ukraine Russia crisis. Although just a pointer that there was no shortage of supply or a rise in demand. It was all factored in. So the markets world over on the equity side also and on crudes also factor in the events in advance. So there was a belief that because of the Russian crisis, the supply might decrease because of sanctions on Russia, and the price of oil will increase. And that's what happened. The price of oil increased world over.
So, to summarize, you've talked about two key factors, that is, oil hitting us in the form of inflation as well as our currency depreciation, which has led to FII outflows as well. So, now let's talk a bit on the Fed rate hikes that have happened. We are expecting five rate hikes this year itself. So, can you talk a bit about what does the US inflation look like? What sort of a rate hike are we expecting in percentage terms, and how does that rate hike affect our Indian markets?
So let's take our perspective. Let me give you an example and try to tell what happens when a interest rate hike happens in an economy. So let's say in today's time, FDs in India are giving us anywhere between 5.5% to 6%. Let's talk about fixed instruments, not equity. So if I give you an alternative that let's invest in, I have an option in Vietnam, Centralized Bank of Vietnam, or let's say a bank in any of the other developing countries. Let's take Brazil, uh, which is giving 10% per annum or 11% per annum. So as an investor, as a foreign investor to these countries, I'll think I'm getting a better rate. So I'll invest in these countries. One risk is that if the current local currency depreciates over there, that impacts my returns. So I have to factor that in, and what I do is I hedge my positions. I hedge. I make a hedging on the currency depreciation, which costs you about roughly about 3-4%. So net all, I'm getting a good return, right, including the hedging. Now, let's compare it to Indian markets and the US markets. US rates were close to zero, or were zero at the time of the COVID impact, the first lockdown that happened. Indian government bond yields were about 6.5, right? So for a US investor, 6.5 was lucrative, including the hedging cost, which was 4%. He was getting a net return of 2.5, so he was happy. Now, when the base rate of their country, which is US, increases, the alpha that he's getting, the advantage that he's getting by investing into India reduces, right? So let's take an example. If the rates increase by 2% over there, right? The hedging cost remains the same, which is 4. So net all in India, the Indian government bonds are giving you about 6.7. So net all, he's getting a 0.7% return. Now he will evaluate at that point of time whether a zero point 0.7 return is so big for him that he can invest into a country like India, or whether he'll prefer investing in US itself, right? And if the rates go beyond that, then India becomes it doesn't become it becomes less attractive for him. So what happens is in times of rate hikes where a local rate hike happens, Generally, the investors of these countries prefer their own home country to invest into, and they pull out from the emerging markets. And the counter is also true. So when the rates dip, they prefer emerging markets or economies outside of US, so that they get an alpha over there on their investments. I hope I was able to make that point clear.
Correct. So you very rightly given the true picture of US rates being at a zero and India rates being at a 6.5% bond yields at the time of the pandemic. Now, when the trajectory is reversing and when rates in both the countries are being hiked, an an FII investor will typically evaluate whether it makes sense for us to take out investments from an emerging country like India, which is already overvalued, and take back to a country which is now seeing rate hikes to take advantage of the higher bond yields.
Yes, and in fact, if the US bond yields go up, we have FIs not only from US, we have from Europe, we have from Japan, we have from different countries, right? For them also, US becomes a more attractive option than India, right? So they also move out of emerging markets because US is a developed space. It's a much more mature space for investors, and they somehow find more confidence in US as compared to India. So their money moves out of the Indian markets and goes to the developed world. So that's what is happening on the FII outflow and the Fed rate hike. But one point I'd like to highlight here, Shalini, that before the Ukraine-Russia crisis happened, when the FII, the news of the Fed and Jeremy Powell increasing interest rates aggressively happened, the Indian markets were pretty resilient, right? So I think I remember, if I remember correctly, from October, November, it started happening that the data towards inflation was the inflation was out of control in US. So everybody was anticipating a Fed rate hike. So at that time, I think the Sensex was about 61 and a half. And before the Russia-Ukraine crisis, it again hit 61 one and a half. But the correction, maximum correction, which happened was about 58,000, which was a 4-5% correction. And as compared to the outflow that we saw, which was about 1.5 lakh crores, a 3-4% kind of a correction is actually is not that bad, to be very honest. But Russia, Ukraine, and the crude added on to the correction at that point of time.
Right. And what percentage of a rate hike is expected to happen this year from US?
So, see, as I said, because of Russia, Ukraine, the oil, the crude oil prices have increased. So it acts as a double whammy, right? It acts on inflation also, but the central banks have to be very cautious about the growth rate also. So they have to balance it out. Uh, so what is expected is the Fed is meeting on 14th and 15th. I think that's Monday, Tuesday. So by Tuesday night, I think we should get the results. But what is expected is a 0.25% hike at the moment in March, another 0.25 in May when they meet again. Point 0.5 is, I think they will not go for a point 0.5 according to us and according to the market consensus, uh, because the inflation has gone up from 7.5 to 7.9, but so has the oil has increased much more steeply. So I don't think they will go for a point 0.5 kind of a rate hike. But yeah, 0.25 is expected in March as well as May. And then, so this year there should be about 4 to 5 rate hikes, which can happen in this year. But I think by May they will settle down a little bit, look at the inflation data. How is the point 0.5 increase that they've done? How is that looking up in on the inflation numbers, and then take a call later on. So a 0.25, probably 4 to 5 times in the year is expected. But interesting point to note, Shalini, that the bond yields in US have already gone up. So as I said, the markets, the stock markets, the bond markets, or the crude markets, commodity markets, don't wait for an event to happen. So they have already factored in that these kind of rate hikes will happen. And if you look at the bond yields of US, that's sitting at about 1.8, 1.8, if I'm not wrong, 1.8, 1.9 approximately. So the bond yields have already shot up in US because of this anticipation. But yeah, so that's what we expect out of the rate hikes.
Summarizing, we're expecting about 4 to 5 rate hikes this year, 25 bips in the next Fed meet on 14th itself. So overall, 1.25 percentage is the rate hike expected as of now. But the inflation data, which will come in within the quarter, will be very instrumental in deciding the final hikes that happen.
Yes, and Shalini, one more point. If you look at historically on the historical data, this is not the first time US have increased rates, right? And you will know about that data as well. So whenever a rate hike has happened, a knee-jerk reaction definitely happened in the emerging markets because of the FII outflow. But in a overall picture, in fact, in that a very interesting data that in that calendar year and financial year, the markets have actually delivered very good returns in the emerging markets. In spite of the knee-jerk reaction that happened in those years.
Right. Let's discuss a bit more on the FII inflows that happened in the last 2 years and the outflows which are currently happening. So 2020 to 21 saw an insane amount of liquidity come in from the US Fed to emerging markets, including India, maximum to India, in fact. So I want to understand from you exactly how much money did the US Fed print in the past 2 years compared to what they've done in the past, and how does it compare to the FII outflows now? And I would also want to have a sense of DII net flows, and I would want to give that to the investors as a take.
Sure, Shalini. So it was unprecedented amount of liquidity. So just to give you a number, uh, Fed balance sheets before the pandemic was about 4 trillion. It is sitting at about 5 trillion. 5 trillion is roughly around 380 lakh crores INR, right? So that's the kind of liquidity we are talking that the Fed actually printed. And just to give you a number, that's 5 trillion US dollars, and India's GDP is about 3 trillion. So almost about 1.8, 1.9 times of India's GDP was printed in these times. Now, India, of course, so when this happened, a lot of money was consumed in US, then a lot of other developed world, developed markets, then the emerging markets, and India got a little share out of that expansion of balance sheet. So to give you a number, and it can be plus minus 5% here and there, but 2020 after the pandemic, let's take it at April 2020 till about December 2020, we got a inflow of FI of about 2.2, 2.3 lakh crores approximately. And then 2021 on January till about October, I'm taking the October, because after that the outflow started happening. We got about 65,000 crores approximately. So in net, April 2020 till October 2021, we got about 2.8 to 2.9 lakh crores out of this 238 lakh crores which were printed by the Fed. So that was huge amount of liquidity which India saw. After October, we've got outflow of FIS. I think it's close to about 1.5 lakh crores, which has already flown out of, which has already gone out of India. On the other hand, if you look at domestic investors, so uh, generally domestic investors in 2020 were actually net sellers. They were not net buyers, right? In 2021 they have started investing, and they've started the inflow. I don't have the exact numbers for the DII domestic DII investors for from October for 2021, but they have been net buyers in 2021, right? In 2020 they did not buy; they were net sellers. So that's the amount of FII we got, and the amount of FII which moved out. So out of 2.2, 2.3 lakh crores of liquidity we got, 1.6 lakh crores or 1.5 lakh crores has already gone out of the system because of the various factors we discussed.
Right, summarizing that for our investors and adding my own inputs to that. So, did you know that 80% of all the US dollars in existence were printed just in the past 2 years? So while the US Fed was sitting at a $4 trillion balance sheet in January 2020, the same balance sheet got expanded to $20 trillion in October 2021. So 80% money printed in 2 years. And in 2020 and 21, FIIs were gave us net inflows to the extent of 51,000 crores. As of 2022, FIIs have turned net sellers, but it is actually the DIIs which are supporting the Indian markets now. So net DII inflows. So DIIs typically talk about domestic institutional investors like mutual funds and large ticket investors, could be an LIC as well. And these have invested a total of 30,000 crores within the past 3 months itself. Abhishek, my next question to you would be on the future, which is something that every investor is concerned about. Tell me what does this calendar year look like? If I divide it into two parts, H1 and H2, tell me what can an investor expect from each of the halves, and then we'll move on to the strategies.
Okay. Uh, so, Shalini, before I move on to what to do, what should be the strategy for this year, one interesting point which I want to add on the DII part, and we have discussed that a lot of times internally, but I think it's not being considered by a lot of people is that we have a separate mutual fund category now of balance advantage and asset allocator funds, right? This category is close to, I think if I'm not wrong, is close to 2 lakh crores, 2 to 3 lakh crores approximately, putting all the funds together. The mandate for these funds are very simple, that they buy or they increase their equity exposure when the markets become cheap, and they reduce their equity exposure when the markets become expensive, right? So what is happening is, and you would notice that a lot of DII buying starts happening when the markets correct, right? That was happening in when the markets corrected from 62 to 56. At 56, the DII buying started and it went back to 61 again. Then it corrected to 57. Then again, the DII buying started happening. So all of these funds which are sitting on a lot of I'll say cash or debt instruments actually have a mandate to shift to equity, right? So at a lower level, these funds, balance advantage and asset allocators, they start purchasing, start buying in equity, and that kind of gives us support to the market. So I'm not saying anything about the funds. What I'm trying to say is at lower levels, the DII starts investing, and that pushes the markets back up. Now, coming back to the question of the strategy. See, the first half of the year, uh, there is a little bit of volatility expected because of two reasons. One is the Fed rate hikes, knee-jerk reactions. Almost everything is settled. Almost everything is factored in, but still, it all depends on the data that comes from the US. Then the Russia-Ukraine crisis is still not over. God knows when that gets over. What will happen to crude? At what prices these will fluctuate? The crude will fluctuate. Uh, the year end, little bit of a year end, which a little bit of factor. The year end of the Indian markets, the financial year might impact a little bit. Uh, but see, what I expect is the expectation is pretty simple. uh, and I tell that to all the investors in my interaction is that you take a dip in the equity market as an opportunity, right? uh, you don't treat it as uh, a negative factor. It's actually positive. In fact, one of the investors I was talking to, 52,800 was the same market point which was equivalent to, for let's say, July 2021. So when that happened in 2022, that gave me an opportunity to actually invest at a price which was available 1 year back. Nothing like it, right? So what I expect is on the crude side. Let's talk about crude first. Uh, Even if there are some sanctions on Russia, and even if the supply of crude reduces by 4-5%, I see the world actually meeting that supply by, let's say, supply from Venezuela. There are a lot of sanctions on Venezuela as of now, and if you see, the pampering has already started happening between Venezuela and US. So if there are sanctions, the sanctions of Venezuela might be lifted, and Venezuela as an economy is, in dire requirement of that sanctions to be lifted, because their economy has been completely crippled because of the sanctions. So that adds on to the supply, even if the Russian supply moves out a little bit. Then the Iran nuclear deal is another option, which they are kind of expediting. So I don't think there will be a much problem of supply. And in fact, if you put sanctions on Russia on the supply part, and even that supply moves down, Russia will find its ways, and it has its allies to, make sure that that supply is there in the market. So I don't think, first of all, the Russian supply will dip. Even if it dips, we have Venezuela to take care of the supply. We have Iran to take care of that supply. Overall, I feel that in a medium term, the oil should settle down below 100 for sure, anywhere between 80, 85, $90 per barrel. By the end of the year, might be 70 also. We really don't know, but I think in a medium term, in this year, it should settle down between 85 to 90. So and 85 to 90 is a very good price for oil, and I think that's not a problem for any of the economy in the world. So oil should settle down because of these factors. If oil settles down, the knee-jerk reaction will go away. The markets should recover back. The Fed rate hikes are already factored in. The data as I gave you, 2.3 lakh crores was the inflow that happened, and 1.6 lakhs have already gone out of the Indian markets, right? So most of the correction because of the Fed rate hike has already happened, right? Until and unless there are some shocks that, someday the Fed decides that, will not increase by 0.25, let's increase to 0.5%, which they will not. What looks like. On the other hand, Russia again used nukes, right? So there are ifs and buts, but on a very kind of a general analysis of the market, I feel that's the way forward. So I think April, May, June, I think June onwards, the volatility will settle down. And my assumption is that the year should be positive. And you know that I'm pretty much, very much a follower of the Indian growth story. So I feel in the next 2 years, 3 years, 1 year, the market should deliver good returns. At least in the next 3 to 5 years, I'm very confident of the markets to give the returns, which are much better than what it has delivered in the last few months.
So, Abhishek, a lot of our investors are not aware of how markets can be estimated. While it is not possible to predict the markets, it is definitely possible to give a logical estimation as to where markets will be in the next 5 years. Why don't you talk about that to our investors at large?
Shalini, that's pretty simple, and that's globally accepted. It's not Indian specific. Any market in the world is dependent on the growth of that country, the GDP of that country, how much earnings the corporates are making, how much GDP growth rate, or what's the growth rate of that country in the GDP factor on the GDP side. So my simple phenomena is that India is a growing country. From 2 trillion, we have come to close to 3 trillion. Then we reach 4, we reach 5. I don't think there are any factors today that anybody can point out and say that, no, boss, India will move from 3 trillion to 1.5 trillion or 2 trillion in the next 3 years. I don't see those factors to be there, or anybody commenting on that to be there. So when we know that the GDP will be 3 to 4 to 5 to 6, the markets of that country has to follow that, right? There is no way at 5 trillion the markets will be at 55,000. No way. Mathematically, there is no way, right? So if India reaches 5 trillion, the Sensex should be between 90 to 100. That's a mathematical estimation, which I'm not going in too much detail of. I can probably do it in a video or something later on, because it's a complex calculation. But just to understand, there's something known as market cap. Market cap is nothing but the current Sensex level into number of stocks. So if your GDP becomes 5 trillion and you take market cap to be the same, let's say 5 trillion, the Sensex should be between 85 to 1 lakh, 1 lakh 10,000 approximately, right? So that's what we are anticipating, and that's what we are telling everybody, that look, if you know that the markets and the GDP of a country has to grow, then at these levels you just keep buying at a dip, nothing else. So even if you bought at 60,000, buy something at 55, buy something at 52, and whatever liquidity is available to you, right? In most in aggressive investors, we have two type of investors. One are aggressive and one are conservative. In aggressive investors, we know that they have extra liquidity in their portfolios every month, right? They have something or the other they keep on buying. For, for conservative investors, we have already asset allocated, and which you can talk about in these strategies. Uh, but the point is, at 52,800 you buy, at 54,800, at 54,55 levels you buy. So if I have 100 rupees today, I buy 30 rupees at 55, I buy 30 rupees at 52, and I retain back a little bit, see how the events unfold, and then invest into the markets. 52, 55, 58, 60, all of these levels in a 5 year period will be equivalent to a 1%, 1.5% CAGR difference on your portfolio, right? uh, at the end of it, if your portfolios are doing well, and if you look at the returns that are generated on your portfolio in a 5 year period, we feel that the Sensex should deliver good returns.
So let me take in what you have told to the investors and let me also add my inputs to it when I talk about the strategies that should be executed by the investors. I have a lot of investors asking me that the markets are very bad at the moment. They are very volatile. Should we invest? I want to wait and watch the markets, and once they recover back, that's when I want to start investing. So let me give an advice to all of the audience at large. There are two things that you should be doing in your portfolio. So, first of all, asset allocate. That's very important. Have a mix of domestic equity, global equity, and a little bit of debt in your portfolio as per your risk appetite. The domestic equity is for the capital appreciation for long term goals. Global equity is for you to insulate your portfolio to geopolitical shocks. And that debt is required for two reasons. The first reason that debt is required for in the portfolios is that it is important to achieve your short term goals because they will assist in capital protection when markets correct. Secondly, debt is also required for strategic reasons because whenever there are market corrections, a salaried employee will not necessarily have an additional surplus to put in the market to take that advantage of a dip. So that is why put a little bit of debt in your portfolios as well. This debt can be maintained in the form of a little bit of liquidity in your bank accounts, maybe in the form of short term parking debt funds in the mutual fund portfolio itself. And whenever there is a market correction, either utilize your own liquidity in the bank account to buy mutual funds and stocks on dips, or you transfer the existing debt mutual funds in the portfolio to equity, thus again buying at dips. Uh, so this is all on the strategy side that we wanted to put to you. We've discussed the global markets, the domestic markets, the strategies that an investor should be following to capitalize upon these opportunities. I would request all of the participants to put in any questions that you would have to either me or to Abhishek, and we can answer them in the time that we have limited.
I,
Sifty, do we have any questions so far?
we have some questions in the chat box, Shalini.
Yes, yes, we have some questions in the chat box. I'll ask one by one. So the first question is from Mr. Sri Prakash Agarwal. How much of Fed rise is expected due to conflict and how much due to US internal factors?
Hi, Mr. Agarwal. I feel you're asking about the Fed rate hikes due to conflict or US internal. So as I explained, so because of the conflict, the crude has gone up, and crude is a double whammy. It doesn't only impact inflation; it impacts the growth of a company, of a country as well, right? So the Fed rate hike will be more or less due to the inflation numbers that they get, and the conflict is, I feel, it's temporary in nature. So the Feds might not take a call basis a conflict. They will take call on the basis of the growth numbers and the Fed and the inflation numbers that they are getting. So it's more to do with US internals rather than the conflict. The conflict can be a little bit, I'll say it will be not positive, but a little bit neutral or neutral to positive, because that will put a, the Fed has to do a balancing act after that, right? So it has to balance the growth also and inflation also. Till now, before the conflict, the growth was very good. Only the inflation was increasing. So it was very clear that the interest rates have to be increased to get that inflation under control. Now, something like a crude has happened, which can impact inflation also and growth of the country also. So now the Fed has to do more of a balancing act. But to answer your question in a very crisp manner, it's more to do with the U.S. internals rather than the conflict itself. Yeah, Prashasti, we can go ahead. I hope I was able to answer that.
Yeah, sure. The next question is from one of the participants. What to do in a roller coaster market? Should we exit at this situation? Should we put some liquidity at this situation? Or should we enter at this point of time?
So see, in a roller coaster, so roller coaster, we have to understand why is it a roller coaster first of all. It's a roller coaster because the markets globally are dependent on an event and the news coming out of that event, right? So Russia attacking, then let's say some mellowed down statements by Ukraine, some mellowed down statements by Russia, then the markets reacting to that positively. So it's a event based reaction. Whatever news comes from that event, markets react to that, right? And crude reacts to that. In a roller coaster kind of a environment, there is no way that you can do an efficient job by booking profits and entering at a low. There's no way, because I'll give you an example of last week. Monday the markets were 50 to 800. After that, Tuesday, Wednesday, Thursday, Friday, markets have gone up way above 55,000. So a 3,000 kind of a hike in the markets in 4 days, right? Now, as an investor, if you would have booked profits, you would think, let's wait it out a little bit. Let's let this get over with. And what you will not realize is that the markets are always future looking. They correct and they go up or down depending on the data that they see already. So by the time you decide to come back, it might be already too late, or by the time you book profits, it might have fallen too much. So what you can do in a roller coaster environment is pretty simple. We always tell everybody to have extra liquidity for events like these. We plan it in their portfolios also for conservative and for conservative to moderate clients. For aggressive clients, they have some liquidity available every month. So whatever liquidity you have every month, just buy at dips. Nothing else has to be done, because sooner or later these problems, will settle down, and you'll get a good push in the markets. So what will happen is you bought something at 50 to 800, you bought something at 54, you bought something at 55, you bought something at 60 also, right? Your average is kind of reduced if you're buying at low. So you buy and you hold. That's about it. You cannot do anything in this kind of a roller coaster, because the roller coaster is too steep. There is a 3,000 rupees dip in one day. There is a 3,000 points recovery in, let's say, 4 days. So there's no way you can time this market. But I'm a firm believer, book profits if there's something technically or macro wise wrong in your economy. In India, there is nothing wrong technically or macro wise. The government is doing a good job. The election results were very positive for the BJP and for the India, for the markets in general. The data on a macro level is looking good. The earnings of of the country is pretty good. So the earning per share of Nifty has almost doubled in the last 1 year, right? So that means the corporates and the stocks, the companies are generating good earnings out of their business, right? Inflation is pretty much under control as per the RBI. They don't see it as a threat. The growth rate of our country is pretty good. So there is no negative factor of moving out of the markets as of now. If you see something which is negative, like probably in 18, 19, probably where there was bit concern about the earnings of the markets, you plan at that levels of what to do, probably enter in a systematic way into the markets. But at these levels, it's an event based market. There's nothing wrong in the market.
Okay. The next question is, how does the strength of the rupee influence an FI's decision to invest in Indian equities?
So I explained that. So for a foreign investor, a depreciating rupee is a negative, right? It impacts negatively on the returns. If I am a foreign investor in India, if my portfolio is giving me 20% returns per annum, let's say, if the rupee depreciates by 5%, my net return is 20 minus 5, which is 15, right? So a depreciating rupee is negative for an FII, and there is a tendency for FIIs to pull out if the currency of that particular country weakens. So, on the other hand, appreciating rupee is positive, right? So, for a FII, a depreciating rupee is negative.
The next question is for you, Shani ma'am. In which portfolio it is good to invest in current situations?
So I think Prayag has asked this question.
Yes,
Prayag,
Pragbesh.
this is a very investor specific question. Your fund allocation should always be a function of A, your financial goals, B, the risk appetite that you are willing to take, and C, how long do you want to be invested for. So, basis these three functions, there has to be a very customized portfolio for you. So, ideally, I would want to have a one on one discussion in order to understand these three factors, and then a fund recommendation can be given to you.
The next question is from Mr. Ayush Verma. How the Russia-Ukraine conflict will affect the commodity market? Abhishek sir?
That's for me or
Yeah.
Shalini? That's for me? Okay.
Yes, that's for
So,
you.
the Russia-Ukraine crisis, in fact, that has impacted the commodity market very positively, because all the commodity prices, like for crude going up, and you look at metal stocks, they have rallied like anything in the past, I think 1.5 months. So crude going up is actually positive for the commodities, and that's what's happened. The metal index itself has delivered a very good return, and even the stocks. If you look at stock level wise, you look at Tata Steel, you look at other stocks which are there, National Aluminium, they've all rallied in the past. So it impact the conflict for the commodities has been pretty positive.
Sure. The next question is, as crude prices hurt Indian Oil, BPCL or RIL, which stocks are outperformance amid these kind of market turbulences?
Uh, so Sifty, I do not pick, or I do not look at stocks basis an event. So I'll not be able to comment on this. That if they hurt oil and BPCL, which stocks are outperformers, because I have to look at a lot of other factors also. But if I give you a general view, oil for crude oil prices going up will not hurt them as such, because they have a leeway of increasing prices. They have not increased prices till now, because till now they have, I was overhearing the conversation by one of the MDs of the company. What he was saying was they've not increased prices as of now, because they have gained also a lot in the past 2 years, right? And they want to absorb it a little bit. But the
Yeah.
moment they feel they're not able to absorb it, they'll pass it on to the consumer. So it's pretty unregulated in India. I mean, there is no this thing that they cannot increase the crude prices if the crude have not, if the crude prices internationally have gone up, they can increase it in India also, and they can pass it to the consumer. They're not doing it because they just want to hold on to it and give it a few months, few days before they increase it. And you will see it in the coming few days, that if crude remains at 106, 112, they'll start increasing the prices domestically also in India. Uh, if the government doesn't decide to reduce their duties and the duties and the taxes on crude, you will see the prices going up. So crude prices will not hurt Indian Oil and BPCL. If you ask me, out of these stocks, which are the outperformers, I have not studied all of these in detail about their financials and everything, but I remember IOCL is an all right kind of a stock with good financials and everything. Not a recommendation again, but that's something what I have seen. So probably IOCL is something you look at.
Okay, thank you. The next question is how a rate hike by US Fed may impact our equity mutual funds portfolio?
I think I've answered that as well.
Yeah, you have
Uh,
answered that.
yeah,
Uh,
I think we have one more question by Mr. Sri Prakash Agarwal. Is rupee depreciating? Is
Long
rupee
term.
depreciation long term? Uh, in India, sir, the rupee has generally depreciated against a dollar. Uh, Dollar is a worldwide accepted currency. Indian rupee is not till this point. And moreover, we are an oil importing country, right? So 80% of our oil is imported from outside, in which we have to pay by dollars, not by rupee. So in a long term, rupee generally tends to depreciate. But that having been said, in the last, I think 3 or 4 years, it has become quite stable, right? So in a long term, it definitely depreciates against the US dollar for sure. Against other currency, not that much, but against the US dollar in a long term, it depreciates. But it has been stable for a good past last 2 3 years as of, and even in the crisis, if you noticed, it did not go up that high from 75 point something to 76 point something. It was not a huge depreciation which happened on INR. Yeah, Shifty, we can take some other questions also if you have any.
Yes, sir. Yes. Will the rate hike may have an impact on our retirement savings?
A rate hike on the rate hike in India,
Yes. Rate hike in US.
in US.
Yes.
No, so a rate hike in US. Sorry for that. A rate hike in US will not have impact in the savings or what was the question again on the retirement savings?
Yes, retirement savings.
Uh, Retirement savings. I don't understand how that will have an impact. Uh, but
The
I,
question is with respect to a portfolio which is there for a retired investor.
for a retired investor. So, a rate hike in the US will have an impact, short term impact in the US markets, in the Indian markets. But I mean, that's a knee jerk reaction. So, if you look at the historical data, also, whenever a rate hike has happened, and these kind of rate hikes have happened in the past also, it's just a knee jerk reaction which happens for a couple of weeks, and the markets are back to normal after that. So, even if you look at this month, for example, January, February, the first 10 15 days, the markets were correcting a lot because the inflation data that we were getting from US was quite high, right? So the markets were anticipating कि Fed rate hike hoga, and a lot of FIIs and FPIs were moving out. This month, in fact, on the way towards the Fed rate hike, which is on Monday and Tuesday, actually in the previous week the markets have gone up. So a lot of these factors of a Fed rate hike happens. It's a knee-jerk reaction, short-term reactions that happen. By the end of, if some time passes by, it automatically settles down. So on the equity side, it will have a knee-jerk reaction for 2 3 months, and that has already happened. After that, the things will be quite stable. On the debt side, rate hikes again, uh, on the debt side also, the money moves out. So would be a short term increase in yield, which has also happened. The yields moved to about 7, close to 7, and come back to 6.6 now. Yeah. So uh, there is, on a rate hike, there are always impacts on equity and debt for a short period, and that short period was probably a February to March, February middle to March, which has already happened, and I think things will get stable coming going forward.
There is another question from Mr. Shri Prakash Agarwal. FD interest rates and how will it move?
So, sir, FD interest rates in India have gone down, right? And we've seen that. 2011 FD rates were about 9.75, 9.9. It's come down to about 5.5%. In a growing economy, the interest rates are always low. We have to understand that because a high interest rates in the market, so if FD rates are high, automatically the borrowing rates are also high, right? If the borrowing rates are high, then that impacts the profitability of companies, right? They have to borrow high, so their profitability reduce. So for a growing country, or for countries who are going towards from a developing to a developed nation, the interest rates will always go on reducing on FTs also, and borrowing also. So look at the interest rates. Let's talk about India. 2010-11 FT rates were 9.75, and the borrowing or the home loan rates at that time was 11, approximately 10
All
and a
the
half,
questions which
11.
was in the chat
Both of
box.
them have come down.
Participants, do you have any other question?
Sifty, you have to mute yourself. Both of them have come down. FD rates have come down from 9.75 to 5.5. The borrowing rates, mortgage rates, and everything, home loan rates have come down from 11.5 to about 6.5, right? And if we look at the trajectory, if we have to become, let's say, countries like, uh, let's say, countries in like UK, like US, in the developed world, there the interest rates on savings or FTs is right now zero. Or if you even talk about their bond yield is close to about 1.5-2%, and the borrowing rate is also about 3%. So going forward, I think in a long term, FD interest rates will keep on reducing. And in fact, by the time we are having this discussion, the EPFO rate has already come down from 8.5 to 8.1, right? So all of these will keep on happening. The FD rates, the borrowing rates, the fixed income rates, the schemes that we have like EPFs, all of these rates will keep on reducing going forward in India.
I think EPFO rate has reduced today only.
Yeah, that's what I said. While we are
Yes.
talking, just got an update that EPFO rates have reduced from 8.5 to 8.1.
8.5 to 8.1. Yeah. Yes, I think I've covered all the questions which was in the chat box. Participants, I request you, if you have any other questions, then you can unmute yourself and ask questions. Is there any questions you want to ask?
Sifty, more or less, we're done with all of the questions that the
Yes.
participants had to ask in the chat box. Investors, thank you very much for joining us in this session today. Okay, I think we have one more thing. All right. So I think Prashasti from Learning and Development has put in a feedback form. We'll request the participants to click on the feedback form and let us know about their thoughts on the session, what they would like us to talk about in our future sessions. And to all of the participants, an absolute thanks, wholehearted thanks for joining us today, as well as asking us all of the questions. Your participation and your engagement with us gives us a lot of encouragement that we are working in the right direction for you, and it also gives us a lot of encouragement to plan bigger and bolder events for you in the future. We will keep on coming with these monthly invites for you in the form of Financial Pulse to talk to you about updates happening in the markets. Please do connect to us on a monthly basis to know what is happening in the markets as well as in the portfolios. Thanks once again joining in. Thank you, Abhishek. Thanks, Sifty, for moderating the session. We'll see you soon.
Thanks, everyone. Thanks for joining in.
Thanks, everyone.
Thanks, Apti.
Bye.
Thanks.